Your 401k statement says you made money last year. Your gut says something is off. Here's the part nobody puts in annual summary. Both of those things can be true at the same time, and the math explaining exactly how that happens, what it's costing you by the decade, and how the system is specifically structured to keep you from noticing it is what this video is actually about. I'm going to walk you through 4 separate mechanisms that are quietly extracting real value from your retirement account right now. Not vague theories, not watch out, fees are bad, boilerplate. 4 specific systems with specific dollar amounts attached to them. And the one everyone talks about, expense ratios, actually the least damaging of the 4. The one that may be doing the most damage has a name most people in this country never even heard spoken out loud. I want to be clear about something up front. I'm not here to tell you the 401k is a scam. It's not. It remains one of the highest return financial moves available to most American workers, especially when there's an employer match involved. What I'm going to tell you is that the road has 4 toll booths, and almost nobody who sold you a ticket told you about booths 2, 3, and 4. By the way, I built a free early retirement calculator because most of the ones online are mathematically wrong. They use simplified assumptions that BlackRock and Vanguard's own research directly contradict. Mine uses their actual methodology to find the weak spots in your specific plan, and I only ask for your email to send you the report. Don't store your financial data. Link is in the description. Here's the meta ties the whole video together, and I'm going to keep returning to it because it's almost perfectly accurate. Your 401k is a toll road. You see the sign at the entrance, the employer match, the tax deferral, the automated contribution, and you think, great deal. And it is a deal, genuinely. But what nobody explained before you got on is that this road has 4 toll booths on it, not 1. Most people sail through the first booth, feel like responsible adults, spend the next 30 years getting quietly drained at booths 2, 3, and 4, while slowly wondering why they're not arriving where they thought they would. You're paying the tolls. You're not seeing the receipts. That's the problem. Let's go through them in order. And fair warning, they escalate. In a few minutes, I'm going to show you something about how target date funds, which is probably what a large portion of your money is sitting in right now, are actually constructed on the inside. And when you see it, you're going to want to log into your account immediately. But first, let me show you why toll booth number 1 is already twice as bad as you've been told. Everybody knows expense ratios exist. The financial media has been covering expense ratios for 20 plus years. So the average person has been told, watch out for high fees. And they maybe switch from a fund charging 1.2% to one charge 0.5% and felt like they'd done their homework. Here's what they almost certainly didn't calculate. The fee number on your fund is not the total fee you're paying. It's not even the majority of the fee you're paying in many cases. There's a second layer most people have never looked for. It's called the plan administration fee, sometimes broken out as a record-keeping fee, a trustee fee, or an administrative services charge. This is what the company running your employer's 401k plan charges to keep the lights on. The compliance, annual filings, the website where you log in and stare at your balance at 11 in the morning when you should be working. According to data from the Investment Company Institute and Brightscope's annual plan analysis, the average total cost for a 401k plan at a mid-sized company, and mid-sized here means under 500 employees, typically runs between 1.1 and 1.9% annually when you add fund expenses and plan administration together. At small companies, plans can hit 2.5% total cost. And that plan administration fee is often passed directly to participants in ways that are technically disclosed, in documents that are technically available, and that approximately nobody reads. Let me make this number land properly. Let's say you have $200,000 in your 401k. That's roughly the median balance for American workers in their late 40s, according to Fidelity's 2024 retirement data. At a 7% average annual market return, the approximate long-run real return of the US. A stock market after inflation, $200,000 compounds to about $1.5 million in 30 years. That's the highway with no toll booths. Now introduce 1% in total fees per year. You're now compounding at 6% instead of 7%. In 30 years, your $200,000 becomes about $1.15 million. The 1% fee didn't cost you $40,000 over 30 years. It cost $370,000. nearly double original investment, evaporated. Not to a bad market call, not to a crash, to a line item you agreed to on first week of work while HR was also trying to explain where the bathrooms were and what time the kitchen gets cleaned. $370,000. That's toll booth number one. And again, it's the one people already exists. Now this is where it gets genuinely interesting. Toll booth number two is hiding inside something that sounds completely responsible. Something that sounds honestly exactly what a thoughtful adult should be doing with their retirement money. And that thing is called a target date fund. There's a man called Robert. He's 53 years old. He enrolled in his company 401k plan back in 2001 when his employer signed with a major plan provider. He looked at his expected retirement age, 67, found the 2035 target date fund, clicked it, and didn't touch it for 24 years. Set it and forget it. That was the pitch, almost word for word. The fund would automatically shift from growth assets to conservative assets as retirement approached. It would do the work for him, responsible, automated. Done. Robert checked his statement in January of 2026. The number went up. He was pleased with himself. He mentioned it at dinner. What Robert never looked at, and what I'd bet serious money you haven't looked at either, is the composition of that fund. Not the composition from the marketing brochure, the actual holdings right now. A 2035 date fund today holds approximately 45 to 55% in fixed income bonds, treasury securities, bond equivalent, depending on the provider. Vanguard runs closer to 46%. Fidelity's Freedom Fund for that date runs near 50%. That allocation is not based on current market conditions. It's based on a formula designed in an era when investment-grade bonds routinely returned 4 to 5% and inflation ran reliably at 2%. That era has not existed since approximately 2008. Here is the problem in early 2026. Core inflation has been running persistently above 2.5% since 2021. As of the data available now, it's sitting in the range of 2.7 to 3%. The 10-year Treasury yield, the benchmark for what a safe income allocation actually earns, has been oscillating around 4.25 to 4.75%. So Robert's bond allocation is generating roughly 4.5% nominal. Inflation is roughly 3%. His real return on that entire fixed income sleeve is approximately 1 to 1.5% before fees. Now stack the math. Robert's target date fund has roughly half his money earning around 1% in real terms. His equity portion, the other half, might earn 6 to 8% in real terms in a decent year. His blended portfolio real return is somewhere around 3.5 to 4.5% on a good year. Subtract his plan's total fee of 1.3%. His actual real return in a solid market year is around 2 to 3%. His nominal balance is going up. Robert thinks he's doing well. Robert is essentially running in place on a treadmill that's been set to a very slight incline, while the finish line stays the same distance away. That's toll booth number 2. And here's the specific reversal I want you to hold on to, because it matters for how you think about this. You probably think the problem is that target date funds are bad products. That's not the problem. Target date funds are actually a fine solution to the problem of people making terrible allocation decisions in a panic. The problem is that target date funds were designed around a model of fixed income risk that was built for a different macroeconomic world, one with stable, low inflation, and bonds that genuinely diversified and generated real returns. That world changed. The funds didn't. You're still being sold the same product at the same glide path in a completely different environment. Imagine buying a winter coat in Florida and being told it's rated for minus 20 Fahrenheit. Coat is fine. You're not in the right climate for it. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm literally never show you my videos again. And I have a video coming next week that's directly related to what we're covering right now. In a few minutes, I'll come back to a specific person, call him Marcus, who did something most people never do, which is actually read the documents and run the real math on his own account. What he found is going to make everything in this video feel very concrete and slightly uncomfortable. But first, I need to show you toll booth number 3, because this is the one that keeps me up at night when I think about American retirement readiness. The Dalbar Institute runs a study they've published every year for over 30 years. It's called the Quantitative Analysis of Investor Behavior. The premise is simple. Every year, they compare what the stock market actually returned with what the average equity investor actually received, not what their funds were theoretically earning, but what the investor actually captured in their account, accounting for the timing of when they moved money in and when they pulled it out. The gap averaged across their most recent data runs approximately 1.5 to 2% per year, every year, consistently, across different market environments, different decades, different administrations. The average investor systematically captures 1.5 to 2% less return annually than the market generates, not because of fees, not because of bad fund picks, but because of the timing of their own decisions. I think fees are the main problem. The main problem is your own behavior under stress. Here is what 1.5% per year means in real money. On that same $200,000 example, over 30 years at 7% market return versus 5.5% captured return, the difference is roughly $480,000. Nearly $500,000 not going to fund managers, not going to the government, just not captured. Existing in the gap between what the market offered and what the investor took home because they moved at the wrong moments. Here's how this plays out in a 401k specifically. During a bull market, everything feels fine. People occasionally see a growing number, feel like adults, maybe even bump their contribution rate up a few percent. Then the market drops 15% in 6 weeks, which it did in early 2022, which it did in 2022, which it did in 2008. Something happens in the brain that has nothing whatsoever to do with spreadsheets. Imagine you're a sailor and a storm rolls in. You have been told repeatedly in calm weather that the best move in a storm is to stay the course. You understand this intellectually, but when the waves are actually crashing over the bow and the boat is pitching sideways and everything is chaos, your nervous system doesn't consult your investment philosophy. It consults 17,000 years of evolutionary programming that says, get out of the situation causing the fear. And what people do with an uncomfortable level of statistical regularity is they move their 401k allocation into the stable value option or money market or something labeled conservative. They do this when stocks are at their lowest, and they stay there until the fear subsides, which is also, not coincidentally, when the market has recovered enough to feel safe. So they sell near the bottom and buy back in near the recovery every time without meaning to, while thinking they're being rational and protective. The behavioral economist Richard Thaler won the Nobel Prize partly for documenting the specific cognitive failures that drive this pattern. What he found isn't that people are dumb, it's that people's brains are running the wrong software for the situation. The amygdala, which handles threat response, neurologically overrides the prefrontal cortex, which is where your understanding of 30-year time horizons actually lives under conditions of perceived financial threat. You literally become temporarily less capable of clear long-term thinking at exactly the moment when clear long-term thinking is most financially critical. The 401k system was designed as if this weren't true. It was designed on the assumption of a rational long-term investor who stays the course. Dalbar has been proving for 30 plus years that the average person doesn't do that, and the system has never been redesigned to account for it. That's three: hidden compound fees, a bond allocation earning almost nothing in real terms, and a behavioral gap that may be quietly costing you more than your employer match is giving you back. But there's one. And this is the one that specifically affects people who did everything right. There's a subplot that's been running background of American retirement planning for the past couple of years. It just got resolved, or at least reached a decision point as we entered 2020. The Tax Cuts and Jobs Act of 2017 included a sunset provision. The corporate tax changes were permanent. The individual rate reductions, the lower marginal brackets, the higher standard deduction were always set to expire at the end of 2025. Whether Congress and the administration extended those provisions or let them expire, and you know by which happened, the whole episode forced a confrontation, the question that sits underneath most retirement planning and almost never gets asked directly. When exactly are you planning to pay the taxes on your 401k? Because here's the thing, a traditional 401k contribution is pre-tax. You contribute today, the money grows tax deferred, you pay income taxes when you withdraw. The entire pitch assumes you'll be in a lower tax bracket in retirement. And for the generation that came before you, the people retiring in the 90s and early 2000s with modest savings and Social Security as their primary income, that was true. They were in lower brackets. Here's who that logic doesn't apply to. Anyone who's been a consistent, disciplined saver for 20 to 30 years has built a real balance. If you have $600,000, $700,000, or $1 million in a traditional 401k, here's what your retirement income actually looks like. At 73, required minimum distributions kick in. The IRS requires you to withdraw a percentage of your balance every year, whether you want to or not. On a $1 million balance, that's roughly $36,000 to $40,000 per year in taxable withdrawals just from the RMD. Stack your Social Security benefit on top of that. Now, here's the hidden trap. The threshold at which up to 85% of your Social Security's taxable income is $32,000 combined income for a single filer. You've just blown past that. Not only are you paying ordinary income tax on your 401k withdrawals, you're also paying tax on 85 cents of every dollar of Social Security you spent your entire career paying into. The conventional wisdom about being lower bracket in retirement assumed you wouldn't have enough retirement income to trigger these thresholds. If you saved well, you do. That's toll booth number 4. And it's specifically designed to hit the people who are most responsible. Now let me bring Marcus back, because I mentioned him earlier, and he deserves the full version of the story. Marcus is 49 years old. He works for a mid-sized regional logistics company in Ohio. Not a small operation, about 250 employees. He's been contributing to his 401k consistently since he was 27. By the end of 2025, his balance was $320,000, up from $290,000 the year before. $30,000 in paper gains. He was feeling decent about it. Then Marcus did something unusual. He pulled up his summary plan description document, which every 401k participant has legal access to, and almost nobody ever opens. He found his total plan cost 1.4% annually. He checked his fund allocation. 60% of his balance in the company's Vault 2035 target date fund, which he'd selected when he enrolled, never changed. He looked at the bond allocation inside that fund, 48% fixed income. Then Marcus ran the numbers I've just walked through. His account returned approximately 10% in nominal terms in 2025, given the market conditions and his allocation. Not bad. But his bond sleeve, roughly 20% of his total portfolio, given the internal split of the target fund, returned around 4.2% nominal. Inflation running near 2.8%, his real return on that slice, 1.4%. His equity sleeve returned about 14% nominal in a decent equity year. Real return, 11%. Blended real return before fees, roughly 7%, minus his plan's total fee of 1.4%. Net real return, 5.6%. Still not terrible. Except Marcus also admitted something to himself, that honesty. In March of 2025, there was a significant market correction. Equity markets dropped sharply over about a 3-week window. Marcus, watching his balance drop by about $19,000 in real time on the plan's app, moved 30% of his balance into the stable value fund. He moved it back in July when things felt calmer. He missed roughly 8% of equity recovery on that 30% during those months. That's approximately $7,600 in gains that simply did not happen for Marcus because he was scared in March and not scared in July. His real, actual net return for the year after fees, after inflation, after behavior was closer to 3.5%. On a year when the broad equity market was up double digits, Marcus did not lose money in nominal terms. He just paid 4 separate tolls he hadn't accounted for and arrived significantly further behind where he should have been. The part of this that matters most is that Marcus is not a financially irresponsible person. He's been contributing for 22 years. He has a real balance. He makes good money. He thinks about retirement more than most people he knows. The system just was designed to give him the complete picture. And without the complete picture, every decision he made felt reasonable. Here's what Marcus did after he figured this out. And here is the numbered framework I walk away with. Because this is where we go from diagnosis, action. There are 4 things, one per toll booth, that you can do right now that are specific to this moment in 2026 and not generic advice. First, find your real plan costs, not the expense ratio on your largest fund. Open your summary plan description. Your employer is legally required to provide it, and find the plan administration or record-keeping fee. Add it to your fund expense ratios. If your total all-in cost is above 0.5%, and you have a balance rolling over, model the math on moving to a self-directed IRA. You can access Vanguard or Fidelity institutional class funds with expense ratios below 0.1%. The roll itself is tax neutral if done correctly. The 30-year compounding difference is not small. Second, look inside your target date fund right now. Go to Morningstar, your fund provider's website, and find the current bond allocation. If you are more than 12 years from retirement and your fixed income allocation is above 40%, that is not conservatism. That is a drag that was designed for an inflation environment that hasn't existed since 2008. You don't need to go 100% equities, but you should know what you're actually holding and it's actually earning in real terms. Third, build a behavioral firewall before the next correction, not during it. This is the one most people completely skip because it doesn't feel urgent when the market is calm. Write down today the specific conditions under which you are allowed to change your allocation. If the market drops, 15% is not a valid condition. Valid conditions are things like if my actual financial situation changes, or if I'm within 2 years of needing this money. Put that rule somewhere, you'll see it in a panic. The written rule from your calm self is the only thing that can override your scared self. Fourth, model your tax exposure in retirement. Specifically, run a simple spreadsheet where you project your 401k balance at retirement. Assume 6% annual growth today, and then calculate what your required minimum distributions would be at 73. Add your estimated Social Security benefit. See what bracket you land and whether 85% of your Social Security becomes taxable. If you find yourself looking at a significant traditional balance and an uncomfortable projected tax bill, the Roth conversion conversation is one worth having with a fee-only advisor, someone paid by the hour, not on a percentage of your assets. That's it. That's the whole framework. 4 toll booths, 4 specific responses. None of it is complicated. All of it requires reading documents that nobody in the system has an incentive to push toward you. I want to come back to where we started because this is where I want the whole thing to click into place. Your 401k is a toll road. It's still the best road. Let me say that one more time clearly. If your employer offers a match and you're not contributing up to the full match, stop watching this video and go do that first. That's a guaranteed immediate return that no market can match. The toll booths don't make the road not worth taking. They make it worth taking while looking at the map. The problem is not corruption. It's not a conspiracy. It's not that your employer wants you poor and your fund company is laughing at you from a yacht. The problem is duller and more dangerous than that. The system was designed in a specific economic era, the 80s and 90s, when bond returns were robust, inflation was controlled and predictable, and the average American worker was dramatically undersaving. The 401k was built to get those people invested, not necessarily to optimize the experience for people who would actually build real balances and face the downstream complexity of that. You are the person the system wasn't fully designed for. I've spent more than a decade running my own business, surrounded by accountants and fiscal lawyers whose entire job is understanding how money actually moves, not how it's supposed to move in theory, but how it actually moves inside real structures. The one thing that genuinely surprised me when I started reading the boring documents, the SEC filings, the plan documents, the Brightscope data, the Dalbar studies, is how much of the real math simply never travels downstream to the person whose money is. The information isn't hidden, it's published. It's technically available to any participant in any 401k plan in America. It's written in a language specifically calibrated to be accurate and incomprehensible simultaneously. Reading those documents is where the real edge is, not finding the next hot sector, not cryptocurrency, not leveraged ETFs. Knowing what you already own and what it's actually doing to your wealth in real, inflation-adjusted, fee-adjusted terms. Think about the farmer who checks the price of his land every single day. Not because he's selling. There's no reason to check. But this is available, so he looks. And in a bad year, land prices drop 20%. He sees other farmers selling, feels the pull, he sells. 2 years later, prices recover, and he buys back in at a higher price than he sold. He needed the land. He sold his primary asset because the daily price was visible and the daily price was terrible. The visibility was the mechanism of the damage, not the protection from it. Your 401k app with its daily balance updates and real-time market moves, is the same thing, designed for your engagement, not for your wealth. There's a concept called real return illusion that I want to leave you with. You log into your account and the number is bigger than last year. Your brain says progress, but nominal growth and real purchasing power growth are genuinely different things. If your balance grew 6%, inflation was 3%, and fees took 1.3%, your real return was 1.7%. On a year, the market may have been up 12%, 1.7% real. That's not growing retirement wealth. That's watching your wealth tread water while your account balance tells you everything is fine. And the road keeps collecting. Lazy investing built more fortune than crypto memes. And here's what lazy actually means in this context, because it doesn't mean doing nothing. It means doing the right 2 hours of boring once a year, not the wrong 40 hours of exciting speculation throughout the year. 2 hours. Read the plan document. Run the real return map. Model the tax exposure. Adjust once. Then ignore the daily noise until next year. That's the move. It's not complicated. It's just that nobody has a financial incentive to explain it to you this clearly. Go open the plan document.